So to kick us off, I kind of want to level set on the topic that we're discussing today. So we were kind of catching up. Arthur and I had a conversation about this backstage, but the title of this is How We Scale to the Next 100 Million Users. And my question for everybody on this panel is that the right benchmark? Is it we want to have as many users on our network as possible, or is there a lower amount where maybe there are higher value users that you think are more important? And if that's what you're thinking, like kind of what's the North Star for you?
I think we have to be clear as to what the definition of a user is. If you take the NASDAQ, for example, who is a user of the NASDAQ? How many users does the NASDAQ have? And if you have a brokerage account and you own stocks, and the stocks is listed on the NASDAQ, are you a user of the NASDAQ? So the definition I find useful when looking at a blockchain is I will call a user any party who's responsible for making the decision to spend fees for doing the transaction. So anyone who makes a decision is a user. If the decision is made by some other party, you're not a user. And ultimately, if you look at blockchain systems, they're very much technical backends. They're not the type of systems that end users typically interact with. With that said, given the model around tokens and the economics around it, I think having a lot of users is actually quite important. So essentially, the reason that a lot of tokens have any value today is largely based on whether you call it like being memes or being a store of value. And then the more fundamental approach to this would be what people have called revenue, which is like how many people are spending in fees, because that actually creates a sustainable source of demand for the token. Now, for a while, there was this idea that blockchains were fundamentally constrained, couldn't scale. And so if you couldn't scale, you would have like all this demand for transactions and a fee market, and you could extract high fees. But scaling's largely been solved. Like blockchains can scale. There's just different ways of doing it. And Monad's doing it a certain way, and like Aptos doing it a certain way. Tezos is doing it the best way. But like there's different ways of doing it, and we can do it. And I think we're getting to a world where transactions are abundant, where the clearing price, of a transaction is going to be zero, right? So you can have billions of people wanting to make transactions or billions of demand for transaction, and then you still have the capacity. So if the clearing price is zero, you have a problem. How do you get revenue? If you have 100 million users, if you have 100 million users making 100 transactions, you can charge them 1 cent per transaction. And from their perspective, paying a dollar versus zero, it's not a big spending decision. So they might be willing to do this, even though the clearing price might be 0.001 cents. You're charging them like way more, but it's such a small fraction of their budget that they don't care. If you have, on the other hand, 100 users making 100 million transactions, they're going to care a lot about the fee, and then you get into a very cutthroat world where the transactions are very small. So like where revenue is going to accrue is anyone who has distribution channels to people who can actually make the spending decisions. Anyway, sorry, I took a long to answer that question, but I think it's an important reason that is often not really appreciated in the industry.
I think I might have a shorter answer to the question and going back to it. So I think the fundamental ask behind it is is users really the benchmark for what makes blockchain or what makes crypto successful? And is that metric 100 million users? Potentially, but actually going back to Arthur's point, how do you even define a user, especially when things are on chain? Is a singular wallet a user? But then, one human could have multiple wallets. Is a bot a user because they also take action on chain? Is sibling or anti-sibling important? And this is just my perspective. I actually think that what is important for blockchain success is more about the utility and usefulness that a specific chain or this industry actually provides. So less about the number of users, but rather usage. If we think about let's just think about trading volumes, for example. I think I looked up this stat not too long ago. So a daily average trading volume across all of crypto, I think, is around 20 billion or so. Not a shabby number by any means, but if we compare that relative to like 24-hour trading volumes of like FX markets, which is in the trillions. I think that's like where we should be going. If we're thinking about like size of the market relative to where we compare to traditional markets or where we compare to non-crypto, if crypto is the next generation of tech, there's still a lot more to go, and there's different ways of measuring that success outside of just pure user numbers.
I'll take a differentiated approach on this one, and to me it's less about the infrastructure here and really thinking about the product. We work with large companies that have access to hundreds of millions of users. Actually, they come to us not with like, thinking about the fees and this and that, but they're concerned about the product experience. For example, we work with NBC Universal. They're thinking about how do we kind of create content that can be viewed, licensed by others, and their audience is hundreds of millions. They do care about the specific product requirements. Can I actually do a significant number of transactions and not have it cost prohibitive to me compared to the cloud? Can I support the kind of scale if I now roll this out to 1% of users and then 2 and then 3 and then it becomes like a Hulu type situation? If 100 million plus people are using it, what's going to happen to that? How do people log in? They have to have a simplified login that's very similar to the internet today. So I think for the 100 million users, it's more about, I think people to hit on this point, it's about the utility you bring to the product experience, and then can you actually generate that utility based on 1, 10, 100 million users. But of course, Aptos is really meant for like that large scale. That's kind of our background, Genesis, coming from Facebook at billions of people, thinking about the way Libra and Diem would serve the kind of world's markets. And those are kind of the customers we're best suited to serve.
Yeah, I think that if I zoom out on this a little bit, right? I think the stat of 100 million users is kind of just, it's one that's easily gameable, as we've seen from many networks and their purported wallet counts over time. I think on the other hand, what actually becomes very interesting is almost like the economic value or the GDP of a blockchain, right? What is their user base producing? What are the businesses that are actually being uniquely built on that blockchain? And then why should they exist? So when I think about the North Star metric for a chain or an ecosystem as a whole, or a blockchain really, it's what businesses are being uniquely enabled on chain, how sustainable are they? Are they onboarding useful assets, useful user bases? And what does that actually turn into at the end of the day? So like, Avery is speaking to problems of massive scale, which I think are champagne problems in many cases and should be lauded. Simply because in the first place, it's like, why do you want to come on chain as a company? And I think that we're seeing, the industry evolve to this point where the combination of the crossover between TradFi companies and crypto companies is no longer a complete meme. It's no longer just the institutions are coming, trust me, right? And I'm sure you guys have all seen this over the past few years. It's become that much realer with the Robinhoods and the Tempos / Stripes of the world. So I think that as we think about this from the Berachain perspective, it's really how can we as a chain or as a network, or any network really, help accelerate the growth of the businesses that's building on top of it. A lot of that, like Avery said, is a matter of UX, because I don't think anyone really wants to use crypto, like actively knowing that they're using crypto. I think people want to know that their transactions are secure. They want to know that they do not have to trust an external counterparty too much. They want to know that it's safe and can be verified and can be transparent. They want to have easy access to credit. But they don't want to be like, oh yes, I'm using X or Y blockchain because I love this blockchain so much. They just want a point and shoot experience, right? And I think Polymarket, Courtyard are great examples of things like this, where I don't think anyone cares about whether it's on a chain or not. They just care about whether it's getting the job done. So our whole thesis, to take this full circle, at Berachain is that the chain should be that base plate to help apps scale and help good businesses scale. So the block rewards from the network actually end up in the hands of revenue-generating businesses on the chain, as opposed to just securing the validator set. And we hope that will eventually help onboard businesses that are reaching tens, hundreds, thousands of millions of users.
I think I tend to agree that we're really at a point right now where it is about the actual onboarding, the actual experience, the actual product. I think you all have built technical solutions that help with the scalability of the tech and the network itself. But Eunice, I want to get back to something you mentioned, because I think this is really interesting when we think about where we are in the world today, and when we look at the way that people are interacting with businesses. AI and AI agents are really big right now. And I think we're starting to see that come into crypto. And I think blockchains are actually great solutions for AI agents in a lot of ways, but I think you mentioned bots as like potentially being a user. But when we think about maybe AI agents as users as opposed to actual humans, have you thought about that at all when you've built out your solution? And when you think about the tech that you're building to scale, do humans and AI agents coexist? Do one of them matter more than the other? And how do you serve them?
Yeah. That specific question has never been like explicitly top of mind per se. I'd say that Monad blockchain has always been built for performance at the basic foundational level, and I think many of us on this panel also think similarly. So that's where the ethos of Monad comes from. And so my two other co-founders, who are formerly from jump trading, high frequency trading backgrounds, really used to low latency systems, and taking that experience to actually have rebuilt the Ethereum EVM client as well as the a net new consensus client as well. And so that's what makes Monad extremely unique. Going back to your question about bots and whether blockchain is a good space for agentic agents.
Yeah, I think that's fair.
For AI agents. Yeah, like whether it's like a good spot for it. Yeah, potentially. But I think it also needs to have like a good balance of like why crypto, why blockchain. What does this technology fundamentally unlock? If it's literally a playground just for AI agents, like to me that's kind of a form of entertainment, or maybe just I don't know, just like a trading bot competition. Maybe that provides some utility from a fun perspective or an entertainment perspective, or let's try to juice a couple more like rewards or yields or whatever perspective. But I don't know how much utility that actually truly drives. So going back to the point of like how can what it is that we're building in this industry move this space forward from like a user perspective, like is blockchain, is the Monad ecosystem, whatever, like, is that actually unlocking new, novel ways of like adding value to the user? Is it solving a problem? Like, I think that should be more of the question. And maybe the answer is that there is like a good in between of facilitating both an agentic space as well as those for real human users.
I'll take a very opinionated approach, which is, for Aptos, we kind of feel there are two strong use cases in crypto. One is to trade assets, and the other one is to support decentralized cloud infrastructure. And we think AI fits into both these cases very nicely. So on the one hand, AI is not great for blockchains because blockchains are very slow compared to traditional systems. They are very expensive for compute. And so that's why we have a project called Shelby we launched with hot storage, but it's going to eventually take on all the roles of cloud compute, inference, on training, all that kind of stuff going forward. And so blockchains become this core centerpiece of a coordination layer for how you can build out all kinds of cloud primitives and really compete with the cloud industry, which is huge. It's a $300 billion a year industry, 30% year-over-year growth. And I think one that's poised to do very, very well for decentralized infrastructure because we can compete on cost, we can compete on user control, and we can compete on like many, many use cases around data sharing that are very novel in this space. And I think the future is going to be this kind of value creation through cloud infrastructure, and then you have value exchange through basically exchanging assets on chain. And AI agents will play a very big role there as well because we had robo portfolios in the past that manage our funds and our assets. The future is going to be AI agents that kind of construct these portfolios on the fly, rebalance your asset construction every minute, every 5 seconds, depending on how cheap things are, right? And I think that's going to be a very, very new world for AI to kind of make its way into crypto and also into our products.
Yeah, I mean, I think that right now, like the best parallel for this is just some very aggressively scripted stuff that you'll see on chain, right? Whether it's high frequency trading or market making bots or whatever it is. And I think in most cases, people just think about that in the case of being able to handle that scale, make sure it doesn't clog up your network, make sure you can actually process all the transactions. I think to answer your original question, though, Eric, like at the end of the day, I feel like one has to build for the human client and then account for AIs that will inevitably be operated by human counterparties at the end of the day, right? And I think that being able to have that on a blockchain substrate is interesting from a lack of bias, a decentralized training, or even inference and contribution of data point of view. But I don't think I've ever actually thought about how one might actually build for a world where AIs come first.
Yeah, that's actually something I wanted to ask, and I'll go back to you, Smokey, on this, is the tech is part of it, and we just talked about, there's solutions out there, and that's relatively figured out, I think. But there are only so many users, human users, let's say now in this case, human users in the world, and you're all obviously competing for those users to come onto your network. So when you think about the other side of the tech, and you think about the people in the community, and you mentioned businesses, right? Building businesses on chain. How do you think about growing that community, onboarding those users? And Smokey, I'll go back to you because I think you kind of hit on this in 2 questions ago. Like, how do you do that? How do you actually attract the users?
Yeah, I mean, to give you a bit of a pithy answer, you kind of have to solve a problem for them, right? And again, sometimes easier said than done. But I would argue that some of the biggest wins or some of the use cases that have actually allowed crypto to get in front of lots of users have been things that were quite simple, right? Before Anchor/Luna blew up, it was a simple, savings account. People wanted that. And I actually would argue that nowadays with the evolution of stablecoins and I'd say how efficient certain on-chain yield systems are, that's actually much less of a myth, right? Of being able to have competitive double-digit yields on your stables. I think so. At the end of the day, you have to figure out what is it that a business is lacking from traditional rails, and how can crypto provide a solution? Is that an access to credit problem? Is that an access to liquidity problem? Is it a means of actually being able to bootstrap growth capital for some of these, let's say, private credit type opportunities where you'll have those Goldfinch or Maple Finance in the early days, like take money on chain, deploy it off chain, rinse and repeat? So when we think about that in the Berachain perspective, we think about that a lot in terms of the CAC to LTV ratio that a company is chasing, right? So how much does it cost them to acquire a customer, and then how much is that customer worth to them over the lifetime of their use of that product? And what Berachain basically does is it exchanges its block rewards for a company's, auctioned off incentives, if you will. It says that normally people don't pay for their block rewards. A validator will stake a bunch of ETH, a bunch of Aptos, whatever it might be, and receive more ETH, Aptos, et cetera, et cetera. In Berachain, the validator set effectively says, hey, this application is willing to pay me $1 for $1.10, $1.20, whatever it is, of my emissions. And as a result, that application is able to use that to drive demand for whatever it is within their product they're really looking to accelerate. But they have to be actually solving some problem in the first place. In that I don't think it can create PMF, but I think it can help accelerate demand and move towards a critical mass to actually drive PMF. So at the end of the day, it's, to build a business on chain, it's why are you on chain? And I think that boils down to, ease of capital formation, transparency and verifiability of transactions, some degree of easy access to liquidity or credit, and access to capital formation as a whole in many cases.
Arthur, I'm curious to hear from you because you have a very mature network. You're the one that mentioned, 100 million users is more valuable than 10 users or something like that. So how do you think about growing that user base for Tezos?
Yeah, I think a lot of people don't really use blockchains, they use wallets. Again, the wallet is a distribution point. And for a while, people thought of wallets as, this kind of like, oh, this is not a good business, it's not going to make money. And then you saw the switch, and I think people started realizing that's when, I would say, MetaMask started, making money hands over fists by integrating swaps. The people using wallets, essentially, they are going to pay a fraction of a cent on the blockchain that's going to actually trade for them. They're going to pay maybe 10 basis points, 5 basis points to the whatever DEX it is that it's going to be routed to. And they're going to pay 75 basis points to MetaMask because they're lazy. It's incredible how much more revenue you can extract by being closer to the users. So how do you onboard people? Well, again, people use the wallet. That's really what that demonstrates. There's so much using the wallet that they're willing to pay orders of magnitude more money to their wallet than to the base blockchain they're using. One of the things in the Tezos ecosystem that we did very early on, I think as early as 2021, was onboarding a lot of people in wallets using social media handles so that they wouldn't have to deal with passphrases. And I think that remains one of the largest hurdle for onboarding people to crypto. It's like setting up a wallet, and then making the first purchase. It's terrible. You want to pay your transaction fees, you want to do anything. It's like, great, you've done this. Now you're going to have to like jump through, even if you want to use a credit card, you're going to just have to jump through a bunch of KYC hoops in order to do this. This remains the highest friction point in bringing people. The second thing, of course, is like, these people need something to do. And we have a lot of great use cases in Tezos, like in many other ecosystems, and not necessarily use cases for 100 million people, right? So we have a absolutely thriving visual art community, which is fantastic. Does it scale to 100 million people? Not necessarily. So the use cases I think that to have the potential of scaling to a very large number of people are probably around payments, around culture, entertainment. But a lot of people have been chasing those use cases, and I think they're a little tough to crack. One of the things we tried, for example, was fandom around sports. Many people have tried that. Very, very low conversion rate. Like it was one approach as a shot to try to get 100 million users. Like, if you want to take a big swing, it is an interesting way to take a big swing, but very, very still like at this stage, low product market fit for this type of activity. Maybe in the future, but I don't think it's there yet. Financial use cases seem to be the one that have the most impediment match with the technology, because if people are going to be making money, they're generally willing to jump through more hoops. They're willing to tolerate more UX pains, and this is reflected in what you see in the market.
Eunice, I'm curious for you because you're kind of the opposite end of the spectrum, where you're building a community now for your mainnet that's going to go live. So how have you been approaching that and thinking about just building that user base early on?
Yeah, well, for a blockchain, it's really an ecosystem. So it's more than just like users that you're looking to bring on board. There's also the element of the applications and what makes the ecosystem actually alive. So maybe I can also touch upon that side. Like, what does user acquisition from developer funnel as well as like end user look like? So when it comes down to it, though, I think the common points are accessibility as well as enablement. One of the core tenets of blockchain, obviously, is this element of decentralization and trustlessness and security. Now, not all blockchains are created equal. Some are far more centralized than others, and maybe nowadays it might not be seen as important, but when decentralization is clear that it's important, it's going to be clear to all. So Monet is designed with decentralization in mind without actually sacrificing any performance. Again, this is also in part because the underlying tech stack has been recreated from the ground up. Anyway, going back to the main point. So from an enablement perspective and a accessibility perspective, one of the core differences of like building an app that's on that's just on like a traditional mobile platform versus one that's for blockchain is like not having to be gatekept by the app store per se, not having to go through specific hurdles that like some centralized like tech company deems to be appropriate or not. You can deploy anything on chain the same way that on a user side you can access anything on chain. I think the question also is less about like how do you acquire 100 million users and more about like why should 100 million users actually want to be on chain using your network. So that also comes down to the use case aspect of like why is it compelling to be on chain? What application use cases are fundamentally better, and whether it's from like cost of capital, cost of user acquisition, or cross-border payments and remittances, just like accessibility, again, I think is the key word here. That I think is fundamentally important.
I kind of think we're saying the same thing, or a couple of people have mentioned this, where we're moving into a world where users won't necessarily know they're on chain, or they're not using you because they just love Monad or they love Berachain or something like that, but it is the actual applications that are being built and the things that people are using that are consumer facing. So Avery, I'm curious from your perspective how you think about incentivizing and bringing people onto your network and have them actually build really interesting things for users.
I think you said it's all about the products. That's like bottom line. I think nobody uses Facebook because it has a MySQL database underneath it, right? Like that makes no sense at all. And that's, I think, the big difference for us has been focusing on the product cases, use cases that we're very excited about and we think that are the most important for crypto. So instead of being a general purpose L1, we're saying, look, trading is extremely important. We're going to make sure that the stack is optimized for your trading experience. We're going to have things like preventing MEV and sandwich attacks by having hidden transactions until they're kind of deep into the ordering phase that aren't possible in their network. So we're going to have the support for kind of giving makers a last look at transactions just before they're kind of completed to make sure that the spreads can be extremely tight in your order flow. Or when it comes to cloud infrastructure, we're going to make sure that coordination layer is extremely well built to support cloud infrastructure that is going to be rivaling what AWS, GCP, and Azure can do in that space. And that verticalization of the stack to support these net new kind of ideas and applications that we think are going to draw in customers. It's less about the incentives, it's more about what you can enable from a new user experience. It just wasn't possible in the past. So I can get better fees. I can actually use cloud infrastructure for enterprise use cases like the NASDAQ and others that weren't possible in the past and now supports new utility for these customers going forward. And so the more we can do that, that's like the real incentive that you couldn't do something in the past that is really serving a need in the market. And I think it requires the entire stack to be redesigned and rebuilt for these use cases as opposed to the previous use cases where people kind of built general purpose infrastructure and said, I hope someone will build something really cool in this infrastructure. I think those days are behind us now.
Can I add something really quick? I feel like at some point technology I think is just going to be commoditized. Like things will be sufficiently cheap, fast, scalable enough. So there has to be other differentiations as well for, again, like why blockchain or why a given ecosystem. So going back to the point that you mentioned about Monet has actually a strong community that has already been formed now. There's an element of distribution that's also extremely important to app teams as well, in being able to find users and also confirm product market fit. You can't confirm product market fit without traction, without usage. One thing that I think is actually pretty cool is amongst the applications that have been deployed on the Monet testnet, they've been getting a ton of direct user feedback from the community themselves that have been using applications on chain. A cool statistic is that about a month into testnet, we literally sent out a Google Doc to the community Discord and was like, hey, please just send in a quick one-liner of like feedback that you have for the apps that are deployed and that you're trying. Within a 2-week period, we had over 30,000 submissions. So those were obviously filtered and then shared to said application teams and project teams so that they could then make improvements to apps before mainnet. But like that's just another piece of the puzzle for why both builders and users and melding them in and within one ecosystem is important.
I'll say a few things which are bearish in general for the space. And so the deal I want to make with the audience is like, even though I'm going to say something that's bearish, if it makes sense to you, I want you to say, this guy makes sense. I'm going to check out Tezos. It's less effective than just being like, yeah, but I believe this. So I agree that commodification is going to be a thing, especially since the cost of software engineering is falling. The AI models for coding are getting better and better, and whilst they certainly cannot code a system like the blockchain today, in a couple of years, they're going to get there. So the technology itself is going to become commodity. It is to a certain extent already, but it's going to be even more so. You were talking about agents. Agents are also going to commodify a lot of things. Like right now, a lot of value in the world is locked into people's laziness. Why is it that OpenAI has the valuation it has? Yeah, it has maybe sometimes better models, great researchers, but also it has insane distribution with ChatGPT, because in people's mind, AI is ChatGPT, and that's what they think. And they don't really want to think longer than that. If you use an agent, your agent is not going to say like, oh, I'm going to go on that blockchain, that's the one I heard about. No, it's going to look everywhere. So everything is getting commoditized. Prices are going to be driven to zero. This is not a great state of affair for things. And in a way, the world in which you're saying like, oh, the user doesn't even know what blockchain they're using, that is not a happy world for L1s. So what is to be done? Well, I do think that blockchains have to be consumer brands. to some extent. And it's tough. There's a tension because on the one hand they are they basically do like back office clearing stuff, which is like not something you'd expect a consumer brand to do. But to leave, they have to be online communities and they have to be consumer brands. So there's a tension here that needs to be resolved. The second thing that can be done, and this was one of the impetus for having governance on Tezos. If you look at the early writing on Tezos and on tokens, one of the theses was most applications don't really need to have a token. Your application in general is going to be an open source application. It runs on a blockchain. It can be copied. The token is like having like a toll in the middle of an open field. You can just go around it. And part of the idea of Tezos is to basically bring back into the protocol directly those applications. So this is also like from a time where people were talking about the FAT protocol thesis, and the idea was, all of the value of the applications are going to accrue to the base token. And my thinking at the time, and I think it has held up, is like that by default, that does not necessarily happen. It happens because it builds hype, it builds attention, but not like from an economics perspective. And if you really want it to happen from an economics perspective, essentially you have to kind of nationalize the applications. At some point, you want to have all this experimentation, but at some point you want to have as a base utility in your blockchains things like borrowing and lending, things like trading, which generate a lot more revenue than you can extract as a base chain. You need to aggregate. You need to be a maximalist in terms of like what your protocol does if you want the economics to work out.
I really like the part there where Arthur pitched a bunch of Berachain for me. But the part that's actually more interesting, in my opinion, is the ability to form a bit of a symbiotic relationship between the chain and its apps. Because it's exactly what you said. The FAT protocol thesis is a little bit of a meme, right? And nowadays, everyone's getting more obsessed with app chains. You say Hyperliquid 3 times and the crowd goes wild, right? And you have to think about how a chain and an app are actually aligned, right? So the whole shtick that I've been saying with Berachain is that as those apps succeed, a portion of their revenues are actually going back to stakers or holders of the Bera token itself. So its source of value isn't just saying, hey, we're going to print a Bera token because there's more Bera token to be printed. It's actually saying, hey, these applications' revenues or governance tokens are going back to driving value here. But to zoom out for a second, I think more importantly, the part that hasn't quite been touched upon in this equation is that of human capital. And I think that's perhaps one of the resources that is lacking the most in the space as a whole. Right, and part of that is a function of the weird regulatory climate that we had for so long, where working in blockchain was sketchy in itself. Working in blockchain was something that made you a pariah, or under regulatory, I'd say, supervision in the U.S. But the bar is objectively low, and I don't mean that in a cocky sense in any way. I just mean that in that the best and brightest are not building on chain as of yet. Some of them are taking that leap. Some of them are getting more comfortable with the concept of blockchain not being a scam. But in order for, I think, a network or a set of networks to succeed and grow, whether that is your social networks like Facebook, your monetary networks like PayPal, whatever your Teslas of the world, I think you need a bunch of very solid network effects to take root, right? You need excellent people and excellent projects attracting more of the same. And I think that we're just sort of starting to get to that phase in crypto as a whole, where you can look at 5 or 10 different groups and say, wow, like that's a bunch of killers. And I think that part of the roles of everyone on this panel, in the crowd, whatever it might be, is to actually find a way to make people believe that there is something interesting to be gained from building on crypto rails as a whole. Because I think if the bar for talent in the space stays where it is right now, I don't think it'll progress very effectively at all.
So we have about a minute and a half left. I want to put everyone on the spot because, again, you're all competing for these users. So I'm going to go, Arthur, with you first. Tell the audience quickly why Tezos is going to win.
Well, I think it's a focus we've had for a long time, and we have taken big swings. And big swings have very high payoff when they work out, but most of the time they don't work out. But we keep trying to do big swings because I think that's where it's at. Trying to compete for the same 1,000 DeFi users by just like throwing a ton of money or a ton of inflation at them is not something that's sustainable and gets you anywhere. So for us, the markets where we see a potential for 100 million users are gaming. And there's a huge focus on gaming. There's Reaper Actual launching on Tezos Etherlink in a couple of days. Arts and culture. I think that also has a potential. There's a product market fit here, and it has a potential of reaching millions of users. And finance, not just decentralized finance, but actual finance.
Monad is building for the future, and we will continue to build in the future as well. The starting point for Monad day one is just strictly a V0. There's going to be more iterations, more improvements. Beyond that, we also have programs that are designed to be supportive of applications on chain. For example, Monad Momentum is an incentives matching program that's specifically designed to work with apps in finding the correct actions of incentivization and conversion of users.
I think less of us are actually competing for users, to be honest. These are different use cases. I think there's a way where everyone can win. But for Aptos, like the vision we really want to see is when you have all your finances happening on chain, whether it's going to be banking, lending, investing, as well as transacting and volume happening in the global trading engine, that's a world we really want to live in. We think it's a huge improvement and upgrade over today's existing infrastructure.
I think that at Berachain, we have a fundamental belief that applications are what define their chains. And I do not believe that there are any other blockchains in existence which are built to support applications from a mechanistic and financial point of view at the base layer in the same way that Berachain is, while making sure that the apps and the chain themselves are aligned over a long-term time frame. And we got some time to prove it out.
All right, well, I'm feeling very bullish after this. I feel like not only are we going to onboard users, but we're actually going to have applications they find useful. So thank you very much to the panelists. Thank you very much to the audience. And yeah, I hope everyone enjoys the rest of the day of day 2.